Are you absolutely 100% sure your retirement plan is safe? Like, really sure? Because what if I told you that the very foundation of most retirement strategies out there is built on a lie? A lie so pervasive, so deeply ingrained, that it's silently siphoning away your future financial security. Today, we're not just talking about saving a little more. We're going to do the math on the hidden costs and flawed assumptions that are actively eroding your golden years. We're exposing the shocking reality of traditional retirement vehicles and why they might be the biggest financial mistake you're making right now. Stick around, because understanding this truth is the first step to actually securing your future, not just dreaming about it. This isn't about fear-mongering. It's about financial truth, the illusion of security. Let's talk about the retirement lie. What is it? It's the idea that if you follow the prescribed path, save a certain percentage, invest in a diversified portfolio of stocks and bonds through a 401k or IRA, and then draw down 4% per year, you're golden. It's the narrative sold to us by the financial industry, perpetuated by well-meaning but often misinformed advisors, and ingrained in our societal understanding of how things are done. But here's the gut punch. This narrative often fails to account for the true costs, the systemic risks, and the psychological impact of a rapidly changing economic landscape. We're told to trust the system, to trust the advisors, to trust the numbers they give us. But are those numbers truly reflecting the reality we're heading into? The math they present often uses historical averages that may not apply to the future, and it conveniently glosses over the fees, the inflation erosion, and the potential for market downturns that can cripple even the best-laid plans. The first major crack in the retirement lie is the insidious nature of fees and inflation. Think about your 401k or IRA. You're paying management fees, expense ratios on mutual funds, and potentially advisor fees. Individually, they might seem small, like 1% or 2%. But over 30, 40, or even 50 years of saving and investing, these fees compound and eat away at your principal and your potential returns. Let's do some quick math. If you have $500,000 saved for retirement and are paying a 1% annual fee, that's $5,000 gone every single year. Over 20 years, that's $100,000 in fees alone, not to mention the lost growth on that money. Imagine that, $5,000 compounded at 7% annually. In 20 years, that's over $170,000 that you've lost to fees. Now, add inflation. The official inflation rate might be 2 to 3%, but the cost of living, especially for essentials like healthcare and housing, often outpaces that. If your retirement savings grow at 7%, but inflation is running at 4%, your real return is only 3%. This is the silent killer, the slow drain that reduces the purchasing power of your hard-earned money. The traditional plan assumes steady growth and predictable inflation, but reality is far messier. The second critical flaw is the assumption of a safe withdrawal rate, most famously the 4% rule. This rule suggests you can withdraw 4% of your retirement portfolio in the first year and adjust for inflation annually thereafter, with a high probability of your money lasting 30 years. This was based on historical market data from the 20th century, but we are not living in the 20th century. We face a new economic reality: higher debt levels, potential for stagflation, high inflation with low growth, and a global geopolitical landscape that's far more volatile. What happens if we have a major market crash early in your retirement, right when you're taking out money? The sequence of returns risk is devastating. If your portfolio loses 30% in the first few years, and you're still withdrawing 4% adjusted for inflation, you're not just depleting your principal, you're permanently damaging its ability to recover and grow. The math here is stark. If you have a $1 million portfolio and lose 30% in year one, you're down to $700,000. If you then withdraw $40,000, 4%, you've taken out over 5.7% of your current portfolio value. This significantly increases the chance of running out of money. The safe withdrawal rate is becoming increasingly unsafe in our current environment. So, what do? We stop believing the lie. We acknowledge the truth. Traditional retirement planning, as it's commonly practiced, is insufficient and carries significant risks. This isn't about panicking. It's about empowering yourself with knowledge and taking control. First, understand your true costs. Scrutinize every fee in your investment accounts. Look for low-cost index funds and ETFs. Second, diversify beyond traditional stocks and bonds. Consider assets that have historically performed well during inflationary periods or economic uncertainty, like real estate, direct ownership or REITs, commodities, or even alternative investments, provided you understand them thoroughly. Third, rethink your withdrawal strategy. Instead of a rigid 4% rule, consider a more dynamic approach that adjusts withdrawals based on market performance. Perhaps build a cash buffer or income-generating assets that provide stability. Most importantly, shift your mindset from solely relying on a future payout to building true financial independence now. This means exploring multiple income streams, aggressively paying down high-interest debt, and educating yourself continuously about how money and the economy really work. Your future isn't predetermined by a retirement plan. It's built by your actions today. Don't let the retirement lie steal your future. It's time to architect your own financial freedom. The truth about retirement planning is that it's more complex and uncertain than the glossy brochures suggest. The retirement lie is a comfortable narrative, but it's not a safe one. We've looked at the hidden costs of fees, the erosive power of inflation, and the shaky foundations of traditional withdrawal strategies. The good news is, you have the power to change your trajectory. By understanding these flaws and taking proactive steps, scrutinizing fees, diversifying wisely, and adopting a more flexible withdrawal approach, you can build a retirement that's not just secure, but truly abundant. If you found this eye-opening, hit that like button and subscribe for more financial truths that will help you build lasting wealth. And share this video with someone you care about who needs to hear this. Let's stop the retirement lie from stealing anyone's future. What's the biggest retirement myth you've encountered? Let me know in the comments below.